Brokerage account. A brokerage account is the most flexible and widely used type of investment account for everyday investors. It allows you to buy and sell a wide range of financial assets, including stocks, bonds, exchange-traded funds, and mutual funds. One of its defining features is freedom, since there are no strict contribution limits, and you can withdraw your money whenever you choose without penalties. This makes it useful for both short-term opportunities and long-term investing goals. However, that flexibility comes with fewer tax advantages, because profits are typically taxed in the year they are realized. Over time, brokerage accounts have become more accessible due to online platforms, making them a central tool for modern investing. Retirement account. A retirement account is specifically designed to help individuals save and invest money for their later years when they stop working. These accounts are often supported by governments through tax incentives, encouraging people to build long-term financial security. Depending on the structure, you may receive tax benefits when you contribute money or when you withdraw it in retirement. The key idea is to reward patience, so there are usually penalties for taking money out too early. Retirement accounts have become increasingly important as life expectancy rises and traditional pension systems become less common. They serve as a foundation for long-term financial planning. 401k account. A 401k account is a workplace retirement plan commonly offered by employers in the United States. Employees contribute a portion of their salary directly into the account, often before taxes are deducted, which can reduce their taxable income in the present. A major advantage is employer matching, where the company adds extra contributions based on what the employee invests, effectively boosting savings. The funds are typically invested in a selection of mutual funds chosen by the plan provider. Over time, the account grows through both contributions and investment returns. Withdrawals are usually taxed in retirement, and early withdrawals may come with penalties, reinforcing its long-term purpose. Traditional IRA. A traditional IRA is an individual retirement account that allows people to contribute money on their own outside of an employer plan. Contributions may be tax-deductible depending on income and other factors, which can lower your current tax bill. The investments within the account grow without being taxed each year, creating a compounding effect over time. Taxes are only paid when the money is withdrawn in retirement, which can be beneficial if you expect your future tax rate to be lower. This type of account has been a core part of personal finance for decades, offering individuals more control over their retirement savings. Roth IRA. A Roth IRA is another form of individual retirement account, but it uses a different tax structure compared to the traditional version. Contributions are made with income that has already been taxed, so there is no immediate tax benefit. However, the major advantage comes later, as both the contributions and the investment gains can be withdrawn tax-free in retirement under certain conditions. This makes it especially attractive for younger investors or those who expect higher taxes in the future. Over time, the Roth IRA has gained popularity because of its simplicity and the predictability of tax-free income later in life. Savings account. A savings account is one of the simplest financial accounts available, primarily used to store money safely while earning a small amount of interest. It is offered by banks and is often insured up to a certain limit, which makes it very low risk. Although it is not designed for active investing, it still plays an important role in personal finance by providing liquidity and stability. People often use savings accounts for short-term goals or to hold money before investing it elsewhere. Historically, savings accounts have been a basic building block of the banking system, helping individuals manage cash flow and financial security. High-yield savings account. A high-yield savings account is a variation of the traditional savings account that offers a higher interest rate on deposits. These accounts are commonly provided by online banks, which can reduce costs and pass on better rates to customers. While the returns are still lower than those from stock market investments, they are significantly higher than standard savings accounts. This makes them useful for storing emergency funds or saving for short-term goals while still earning some growth. The balance between safety, accessibility, and improved returns has made high-yield savings accounts increasingly popular in recent years. Certificate of Deposit, CD. A certificate of deposit is a financial product where you agree to leave your money with a bank for a fixed period of time in exchange for a guaranteed interest rate. The terms can range from a few months to several years, and generally, longer terms offer higher returns. Unlike a regular savings account, you cannot freely withdraw your money without facing a penalty, which encourages disciplined saving. CDs are often used by people who want predictable and stable returns without exposure to market fluctuations. They have been a long-standing option for conservative investors seeking security and certainty. Education Savings Account. An education savings account is designed to help families prepare for future education expenses. These accounts often provide tax advantages when the funds are used for qualified costs such as tuition, books, or housing. In some cases, governments or institutions may offer additional incentives, such as matching contributions or tax credits, to encourage saving. The structure of these accounts reflects the rising cost of education and the need for long-term planning. By investing early, families can build a dedicated fund that reduces financial pressure when education expenses arise. Health Savings Account, HSA. A health savings account is a specialized account used to save for medical expenses, typically paired with a high-deductible health insurance plan. It offers a unique combination of tax benefits, where contributions may be tax-deductible, the funds grow tax-free, and withdrawals for qualified medical expenses are also tax-free. This triple advantage makes it one of the most tax-efficient accounts available. Over time, unused funds can accumulate and even be invested, turning the account into a long-term savings tool for healthcare costs. As medical expenses continue to rise, HSAs have become an important part of financial planning. Trust Account. A trust account is a legal arrangement where assets are held and managed by one party for the benefit of another. It is often used in estate planning to control how and when money is distributed to beneficiaries. Trust accounts can be customized with specific rules, allowing for long-term management of wealth across generations. They can also offer certain legal and tax advantages depending on how they are structured. Historically, trusts have been used by families to preserve wealth, protect assets, and ensure financial stability for future generations. Custodial Account. A custodial account is created for a minor and managed by an adult until the child reaches a legal age. The assets in the account belong to the child, but the adult is responsible for making investment decisions and managing the funds. These accounts are often used to save for future expenses such as education or housing. They also serve as a way to introduce young people to investing and financial responsibility. Once the child reaches adulthood, they gain full control of the account, making it a long-term gift with lasting financial impact. Margin Account. A margin account allows investors to borrow money from a brokerage firm to increase the size of their investments. This can amplify potential gains, since you are investing more than your own capital. However, it also increases risk, as losses can be magnified and may require you to repay borrowed funds even if your investments decline. Margin accounts often include interest charges on borrowed money and strict rules to maintain a minimum balance. Because of these factors, they are typically used by more experienced investors who understand both the opportunities and the risks involved. Robo-Advisor Account. A Robo-Advisor account is managed by automated software that builds and maintains an investment portfolio based on your goals and risk tolerance. After answering a series of questions, the system allocates your money across different asset classes, creating a diversified portfolio. It also automatically rebalances the investments over time to keep them aligned with your strategy. This type of account has grown in popularity due to its simplicity, low cost, and accessibility. For many people, it provides an easy way to invest without needing deep knowledge of financial markets or active management skills. Subscribe for more simple and easy-to-understand finance explainers like this, and let me know in the comments how you liked the video, what you found most useful, and what topics or ideas you'd like to see explained in the next videos.